All right, so Abrokwah Charles Limited has been trading at a loss for a number of years. The board of directors of the company is now considering the option to liquidate the company or to reconstruct it. The following statement of financial position is available. Guys, a minute, please. Okay, so it says that the following statement of financial position is available. Hello. Okay, so the following statement
Hi.
of financial position is available as at 31st December 20 something. All right, so we have non-current assets such as goodwill, development expenditure, land and building, fixtures and fittings, plant investment. We come to current assets such as inventory, account receivables. Then it goes on to say less current liabilities, bank overdrafts, trade payables, directors' loans, accrued interest on debenture. Then we have financed by stated capital, ordinary share, preference shares. Then we come down to look at the income surplus. Then we come down and look at the capital surplus. Then we look at the debentures as well. So the first information says that additional information, preference dividend is 5 years in arrears. Preference dividend is 5 years in arrears. Then it talks about the debenture are held by Adoma Bank Limited and are secured on land building. The bank has requested that the arrears of the debenture interest to be paid and have intimated that they might lend the company a further 50,000 on the condition that the company increases the collateral and the shareholders inject additional capital. The board has demanded the overdrafts to be repaid immediately. The directors have agreed to waive their loans if they are granted employment. The ordinary shareholders have promised to introduce an additional capital of 100,000 and granted the directors their job. Development expenditure and goodwill is to be eliminated. The cost of reconstruction scheme is 50,000 and liquidation expense or liquidation cost is estimated at 6,000. Trade payables include tax liability of 500 cedis and net payable of 600 cedis. VII. The directors have decided to purchase additional plants costing 30,000 to modernize the production system. The estimated break-up values in respect of liquidation and replacement cost of assets are given below. Liquidated values, replacement cost, land and building, fixtures and fittings, plant, investment, inventories, and account receivables. Suggest a scheme of reconstruction which will be accepted to all parties concerned. The report should include a reconstructed statement of financial position of Abrokwah Charles Limited after the reconstruction. So the first thing I said here is that we need to prepare the liquidated. So we need to look at the liquidation aspect of the question. So position of the company, if it is liquidated and proceeds are distributed. So when we say liquidation, we are going to use these liquidated values as consideration received, and then we distribute it according to the very 7 steps of the liquidation. And what are these very 7 steps of the liquidation? It says liabilities on fixed charge. Yes, so after liabilities of fixed charge, we look at liquidation expense. Liquidation expenses, the next one becomes preferential payables. That is payments to the statutory bodies, payments to employees of the firm. Then the fourth point is looking at liabilities on floating charges. Liabilities on floating charges. The fifth one would look.
Hello. Mhm. We can't see your screen.
I think you're the only person who has seen the screen.
The same here.
You also cannot see my screen.
Yes, it's not showing.
Please, who else again? Okay. So just like I was saying, I was just describing how the liquidation would go about. And then we start with the consideration. After taking the consideration, that is with from the liquidated values, we less the 7 expenses that we need to take out, which has to do with the liability on fixed charge, the liquidation expense, the preferential payables, the liabilities on floating charge, unsecured debt, and then the preference shareholders as well as the ordinary shareholders. So from our question, it's from the additional information that we can pick up all those things from. The first one says that the debentures are held by and then they are unsecured on land and building. So from the first point, when we are doing liquidation, we have seen liabilities on fixed charge. And how much is the debenture? The debenture was 51,000. Its interest is also 4,000, which is at the liability aspect of the question. So by so doing, you know that you have actually treated this and this as part of the liabilities on fixed charge, because we are saying that from the very footnote number 2, secured, and that is the important thing. Then these are the two items that constitute the um, liabilities on fixed charge. The next one says liquidation expenses, and therefore we can find liquidation expense here or liquidation cost here, and the cost is 6,000 Ghana cedis. So once we are doing it, you'll be following or you'll be falling on the fact that you need to be checking the balance to know if whatever you have can be able to pay off the remaining or the subsequent um, outstandings. The subsequent outstandings. So to begin with, we have the Abrokwah Charles written nicely, and then we go ahead to pick the considerations that we receive as the liquidated values. For land was 120, building 110, 10. Then we have the remaining that is following suit. After which you do the total and realize that we had 360,000 for the liquidation. So once we do for every distribution, we confirm the outstanding if it can be able to take care of the next expenditure. But then 51,000 is way below 360,000. 4,000 is way below 360. So you don't really bother much when you are going on. So the next item from the list, that is the point number 2, was the liquidation expense, which I have highlighted in the question as the 6,000. So we add the 6,000. So we know 4,000, 6,000, 51,000 from 360,000. There is more to take care of the next expenditure. And the next expenditure, we've been made to understand that we have something called preferential payables. Preferential payables. Now, in this preferential payables, we have taxes. We have the tax liability, and then we have the SNIT payable. We didn't have employees loan, so this constitutes the tax liability, the preferential payables. Then we ask ourselves, do we have any floating charges? No, we didn't have a floating charge from the question that I read. Then the next from there will be liabilities on secured debt. Unsecured debts are any other liability that we can find here without any floating on liquidation. So bank overdraft is one of them. Trade payables is one of them. Director's loan is one of them. But then the footnote made us understand that it is out of the trade payables we had tax liability and SNIT. So the whole amount for trade payables, which is 60,000, will not be what we are going to write in or under our unsecured debt because we have already charged the 500 and then the 600 to preferential payables because they were inclusive in the trade payables. Okay, having said that, we are done or we have treated all the expenses with respect to the unsecured debt. Now, the next thing is to ask yourself, what is outstanding for us? Whatever is outstanding for us is 204,000 cedis. So the sixth point was that we should take care of preference shareholders and realize that in our preference shareholders, they contributed a 100,000 and then they are also eligible to what we call an interest of 220% on the amount they contributed for a year. But then we owe them for 5 good years. Since we owe them for 5 good years, after determining 1 year, that is 20% of the 100,000 for determining 1 year, we can boldly say that the 5 years multiplied by what we are supposed to pay them for 1 year would give us the entire 5 years, which is also another 100,000. So the value we are supposed to pay them plus whatever we owe them to add up to it as in arrears constitutes whatever we are paying to preference shareholders, which is 200,000. We are only left with 204,000. So we realize that there's just 4,000 outstanding for us to take care of. Now, this 4,000 outstanding must be used to pay or settle off the next item, which is shareholders. But then shareholders contributed 200,000, an amount of 200,000 with 200,000 shares. So we can see that we don't know who to attribute this figure to. So since we don't know who to attribute this figure to, write the figure of the total number of shares, multiply by the amount per share, and know how much each shareholder is expected to receive. So from what we have each shareholder receiving 0.02 for every 1 cedi share we have contributed to the firm. And that would end the liquidation aspect of it. Now we set maximum loss or maximum profit. So the maximum loss basically will be dealing with the replacement cost vis-a-vis the book values of the assets. But then it is not everything that we have in our financial statement or financial position that must be recorded in our maximum loss computation. All assets will be there. One, all assets will be there. Then we then charge some few items. So this well. We charge some few items such as income surplus, capital surplus, and also the dividend to be paid to preference shareholder in the maximum loss computation. After which we put also the reconstruction cost of the 50,000, and then we add that of the director's loan as well to it. So book value and then the replacement cost. The net book value are the figures in the balance sheet, and then the replacement costs are the figures that were given to us here. So you write down all the assets and you write the book value right before them. So the assets actually started from goodwill to account receivable. Goodwill to account receivable. So if I have from goodwill to account receivable, what are their book values? These are the book values of the items. Okay, after listing the book values of the items, we go and look for the replacement cost and write them before it. Goodwill did not have any replacement cost. Development expenses did not have any replacement cost. But land and building did. Fixtures and fittings also did. Plant also did. Investment also did. Inventories also did. And then account receivable did. And then when we come to the maximum loss, we say that in determining the maximum,
And please, it looks like your network is breaking. Your line is breaking.
Brampton for Is it better now, please?
Bernard,
Is it better?
not off.
Eh, Okay. So let me continue. Okay. I can only see just one bar. Okay. So after writing the book value, we said we are going to look for the replacement cost and write them before it. But then in the replacement cost, under the assets goodwill, there was no replacement cost. Under the assets development expenses, there was no replacement cost. Under the assets land and building, yes, there was a replacement cost. So we are replacing the land, which is costing 80,000 with 110,000, which is not a loss, it's a gain. And we said that under the loss, anything that is a loss is that the when we actually mean a loss, it means that the book value, that is the current value or the book value, is literally greater than the replacement cost or is greater than the revalued amount. That means that you are making a loss. The market is selling the item for 0, but then you also have the item recorded as 30, meaning that if you go and sell the asset, you don't make any money, you make a loss. Okay. But then if the asset is being sold for 110 and then you have it at 80, if you sell it, you make a gain. That is when the replacement cost is higher than the book value. But here we are recording only losses. So since we are recording losses, then how do we record the losses? Make sure that the losses are not recorded in negative. They are rather recorded in positive, and then the gains are rather recorded in negative. So this would be interpreted as a loss. Okay, ideally, losses are supposed to be negated. Yes, I agree. But then, so that we'll be able to interpret it and not get ourselves confused, we are saying that treat the losses positive. If you want to treat it negative and you not be confused, fine. But note that there was nothing for goodwill at its replacement cost, so you are losing if you are supposed to sell, because you'll be selling at 0, so you'll be losing. Same for development, you'll be losing 30,000. But for land and building, you'll be gaining some 30,000, which is a gain. A gain should be in bracket. So anytime you see a bracket, then that means that you are making a gain. But then if you see a positive figure without a bracket, it means that you are making a loss. The asset is being valued at 15,000. The market is selling it for 12,000. If you sell it, you'll be losing definitely about 3,000. So the same thing applies to the other cost, which is plant. 33,000 being valued for in the market at 25,000. If I take it to the market, I'll be losing 8,000 on the item. Investment, your investment is being sold for on the market for 60,000, but you actually bought it for 55,000. So if you go and sell it for 60,000, you'll be making a gain of about 5,000, which is why we have kept in the bracket. Then we come to inventory. The market is being valued at 24. Your books, you said it's 50, meaning if you sell it at 24, you have lost or you've lost 26,000 on the item. So on and so forth. But then we said that the income surplus is already negated. That is why you were reconstructing. That is why you are reconstructing. So if you only reconstruct when your income surplus is negative. If you have a question and the income surplus is positive, then you don't need to reconstruct because you are making a gain. So why should you reconstruct if the firm is making a gain? The firm is not making a loss. So let us look at that aspect too very well. If you go and then the income surplus is positive, draw the attention of the lecturer that the question is wrong. It is only under a condition whereby you are making consistent losses. That is where if you're making losses, that is where you realize that um, you can have to reconstruct. I'm getting feedbacks that my network is bad. Don't worry. If you cannot hear me, please just draw my attention, okay? I beg you. Because I think it's becoming intentional. Someone has reported this to MTN per year. Okay. So having done up to the last assets, I said items that we can find there are the income surplus, the capital surplus, and then also the preference dividend, interest on preference dividend, director's loans, if there are any in the questions, and then also the reconstruction cost. So we have our income surplus, which was negative. So negative, I recorded as a positive figure. Then a capital surplus, which is positive, which is a gain, was actually recorded as a negative figure. And then likewise for the other one, which is the reconstruction cost. A cost is an expenditure, which is definitely a loss you are spending. So that is how come the cost, reconstruction cost is also 50,000. And then loan, director's loan is actually a liability. A liability is actually a negated item. You are liable. So if you're making payments, you are obliged to you are forced to take cash from yourself. That is how come that is also a positive here. So a positive is a loss. Now, when you add everything with inclusion of the gains, you realize that your maximum capital loss is 269,000. 269,000. So this is just what you're supposed to do. Yesterday, I was just trying to go an extensive mile with you. But then let us not take ourselves to that extensive mile. Let us just end here. It says that if the company constructs, the maximum loss of 269 should be borne by the ordinary shareholders who should have sustained a loss if the company should have liquidated. So they are already not sustaining a loss. They are not in good standing here. They are unable to sustain the loss because after paying everything, they can't pay themselves. So if they cannot pay themselves, then
Hello, Mr. Bernard.
yes, boss.
Yes, please. I have a small question to ask.
Show me. Don't ask me.
Okay, so
You
what
said
I
you
want to ask is what I want to ask is with the solution that you've provided us with this one, this question, this Abrokwah question, right?
Yes, sir.
What is the real the solution? Are these all the solution for this question?
Yes. These are the solutions for this question.
And so, but the question, the requirement is not saying we should prepare all these things, and I seem not to understand it.
It says suggest a scheme. And then yesterday I was trying to tell you that once we see a question says suggest a scheme, it requires you to do a maximum loss and then asks you to do the liquidation. Okay. But then if the question does not want you to suggest a scheme, the question would tell you that prepare the liquidation of the company or prepare the capital reduction of the company. So yesterday I said the question can come in three folds. When you hear suggest a scheme, then it means you need to do the liquidation and you need to do the maximum loss. And then compare the two. Here, shareholders have been able to pay all their debt, so they are not liable. Just that they would have to give up on their debt. So you see, they will have to give 0.98 of what they have contributed to the firm under the liquidation. They are just going to take 4,000 after they have paid everything. And so they only have 0.02 coming to them. Meanwhile, every shareholder paid 1 cedi. So meaning they are definitely losing 0.98 when they have liquidated. But when they are not liquidating and then they are looking at maybe revaluing, they have incurred a loss of 269,000, which they are supposed to use their personal belongings to come and suffice that. Do you get my point, sir? Big man, do you get me now?
Yes, please. Thank you.
So please look at it carefully because yesterday Felix asked the same question. And then I told him, you see, in a question like this, you have been told, prepare a statement of financial position after the reconstruction on the assumption that the capital injection takes place. Then compute the expected profits after tax, and then the earnings per share 4, and then prepare a statement of distribution if the company were to be liquidated. Now, this question had told you what to prepare. So you are going to do capital reduction, ordinary share for A. The A, you are supposed to do capital reduction, ordinary shareholders account, bank account, and any other account. So the major 3 accounts that you expected to open under A are these 3 accounts. The capital reduction account, which the credit side will be recording all gains, and the debit side will be recording all losses. Then you come to the bank account. You know what bank account is used for. And then you come to your ordinary share account, which you know what is used for. When you are done, you use that 3 accounts, the capital reduction, the ordinary shares, and then the bank account. You use them to come and prepare your statement of financial position under A. But then under B, it says you are expected to compute the profit after tax and then the earnings per share. You know, earnings per share would be definitely your earnings divided by the number of shares the firm has after reconstruction. So this one will be after reconstruction. How many shares do you have now? And then you tell us the number of shares you have now, and then you divide the total amount you have for the ordinary share account, the T account, the ordinary share account. You know the number of shares from that point of view. Then you come to prepare a liquidation expense account. That is when you come and do the distribution. This is how a question can be given you. But then in another way round, if the question tells you to suggest a scheme, is what I'm telling you. You use the type 3 of the capital reduction. And the type 3 of the capital reduction, yesterday I mentioned about 7 steps, but we are trying to omit the remaining 5 steps and just do the 2, which is to compute for maximum loss and do liquidation. Ideally, after doing for capital reduction, doing for liquidation, we are supposed to look at the new capital structure. We are supposed to look at the working capital management. We are supposed to write a short note that what management have adopted is this. Management have actually adopted this strategy in preparing or reconstructing or bringing up their new scheme. So these are the 2 schemes that we have looked at. If management decides to liquidate, management shareholders, when shareholders decide to liquidate, they are going to give up everything and even run at a loss of about 0.98 on their investment. But then with this one, they are going to run at a loss of about 269,000, and then they'll be obliged to pay everything out of whatever they have as management. Okay. Then after doing this, you now come and look at the reconstruction of the financial statement. So we first prepare what we call the bank statement. You see, so if we're doing the capital reduction, guys, a minute. If we're doing the capital reduction account, we would have seen ourselves preparing capital reduction account, bank, and then ordinary share. So after preparing the maximum loss, knowing what you have lost, before we can actually be able to reconstruct our financial statement according to this. So it says the report should include, if it has said suggest the scheme, we would have done just the maximum loss and then the liquidated, and then we are done. We don't need to bother ourselves. The maximum loss and then the liquidation. That is it. But then the points continue to say full stop. The report should include a reconstructed statement of financial position. The report should include a reconstructed statement of financial position of Abrokwah Charles Limited after the reconstruction. And therefore, we need to create a new financial statement from this financial statement. And then our reconstruction here, because we're suggesting a scheme and we're using the maximum loss, it is the maximum loss figures that will translate to prepare our financial statement. And then how do we go about preparing a financial statement with this maximum loss related issue?
Rồi là sao các con?
Okay, so I hope I've answered your question. I hope I've answered your question. He's not just the only person who.
Yes,
No.
yeah, better, yes, better, yes, please. Yes.
But then, you are not the only person who didn't understand it too, but they will not talk. But when I'm asking, I hope I've answered your question. They are waiting for you, the one who asked the question, to come and respond. So if you don't say yes, then that means that everybody understands. So let's go on. All right.
It is not
Yeah,
every day we get
Bernard,
Shama asking questions.
I asked because of the first question that you showed. You see, they have lined up the items in the requirement that you have to prepare.
Yes.
Yes,
That's
that
what
is the reason why I came to ask, because I'm seeing that if you are preparing something, one thing, but you are preparing plenty of things. So I wanted to be sure that
Yes.
this
So
answers.
just
I thought
like
maybe we're using the question, one question to do like answer some distance.
so just like a question like this, Adwa Frema, you see, you have a requirement. It says required, prepare. So the question is expecting you to have prepared capital reduction account.
Yeah.
Then 2, prepare the statement of financial position with the capital reduction accounts that you have prepared. You see, this is a requirement of a question. And that is why I'm saying that looking at our question here, we are supposed to suggest to them. So which one would you have even suggested? In case you've been asked to suggest, which one would you have suggested? Me, I would have preferred the company to liquidate, because management would have just lost about 194,000 of their investment. Because when you look at the ordinary shareholders, when you look at their figure, it's 200,000, and in the 200,000, they have only received 4,000, so they are going to lose about 196,000. They are just going to lose about 196,000.
Bernard,
I'm here. Well, I thought I've left.
yes.
No, I'm waiting for you to process it. Okay. So I would have suggested a scheme whereby managers, shareholders would rather lose 196,000 rather than to bear a cost of about 269,000 as a loss. So the loss becomes like a burden for them to bear now. And so they are supposed to bear this 269,000 loss, which, looking at 196 to 269, which one do you think you suggest for management? That will be the first aspect of the question. The next aspect of the question is saying that, hello, let us reconstruct a statement of financial position. So to reconstruct statement of financial position, we need to visit and prepare some accounts. And then one account that we need to prepare will be a bank account. Why would we prepare a bank account? Because there are some transactions that are taking place using the bank. Which one is that? The VII, this one. The VII aspect of the question even tells you that you bought an asset. Now, my dear friends, you even owe the bank 20,000 at the initial. They are saying that at the latter part, you go ahead and go and buy an asset of 30,000, meaning you still go ahead and owe the bank, right, of about 50,000, because you go ahead and borrow extra. But then, thanks be to God, someone introduced some capital to you, 100,000. Okay, so this person introducing 100,000, the company is also likely to get an extra 50,000 as a debenture, as a loan. So they are likely to give you an extra 50,000 as a loan, and then another person wants to they want to invest another 100,000 in your firm, which will come all in as through the bank or through the cash. So the bank account records receipt on the debit side and payment on the credit side. And an overdraft means that the bank account had a credit balance. An overdraft simply means that the bank account had a credit balance. So if you look at the bank account here, actually, mosquitoes will enter here. Okay, so look at the overdraft account. The bank account has an overdraft. That is how come it's on the credit side, sorry. So the credit side means that it was an overdrawn account. which is 20,000. Okay. Now, so the extra. All right, so the next point starts from II. It says that the bank has requested that the arrears of the debenture interest to be paid. Now, you were owing a debenture interest of about 4,000. They are asking you to pay it. So if you pay out of your bank, it means that on the credit side, money will be leaving you. That is how come we have accrued debenture interest 4,000, meaning that we have been instructed to pay that one as well. Now, the next point says that after you pay that one, they might lend the company a further 50,000, meaning that you'll be receiving another loan in terms of debenture of 50,000. And if you receive, it must go through your debit side of the account, 50,000. So under II, we've been told to pay off an amount from our bank and then also receive an extra 50,000. So once you are doing the 4,000, we'll be receiving 50,000. That is how come we have 4,000 and then we have 50,000 here. Now let's go to the next one. So for the repayments there, it's already on the credit side, so we don't need to really bother ourselves. Okay. Now, the directors have agreed to waive off their loan if they are guaranteed or they are guaranteed employment. Now, since they are guaranteed this employment, their loan, which is supposed to be in the balance sheet, needs not to come because they've waived it. So this 15,000, when we are reconstructing the statement, it wouldn't come. You realize that I posted a solution and I later picked the solution. So the 15,000 loan must not be, shouldn't have been present in our construction of the balance sheet because the statement is saying that if we give them the employment, they are saying they don't want the company to owe them. So we will not owe them the 15,000 again. Now, it continued by saying that the ordinary shareholders have promised to introduce an additional capital of 100,000. Once you introduce an additional capital of 100,000, what happens? Let's look at debit credit. What happens? Debit credit, what happens? Yes, debit credit. Once you introduce capital, you need to certainly debit your cash or bank account and credit your capital account. So which capital account would we credit? We will credit ordinary shareholders account. We will credit the ordinary shareholders account, but then we will debit the bank account or the cash account for receiving the money that have been introduced to the firm. And so we have the 100,000 in the bank account. It means that our shareholders account should have 100,000 also recorded in there. Now, the next one says that development expenditure and then goodwill to be eliminated. So that one, we already eliminated when you are preparing the new statement of financial position. Then the next one, which is the VI, said that the cost of reconstruction scheme is 50,000. That one will certainly have to pay it because the one who will come and do it will not do it for free. And how do you pay the person? You pay the person from either your cash or your bank. That is how come we have a reconstruction cost of 50,000 because you are paying off the person. Now, having paid off the person, trade payables include tax and then SNATE. So tax and SNATE will be paid and must be paid in a year. So these are statutories. Tax, SNATE, 500, 600 must be paid. Then the last part one footnote says that we have purchased plant. When we purchase plant, we'll credit our bank or cash account and debit the plant account with that amount of money. So we'll debit plant account with the 30,000 and then credit cash and bank with the 30,000. Now, when you do the debit side and the credit side, you realize that this time around, the balance carried down is rather on the credit. So our balance brought down will be on the debit. Now, it means that we no more have an overdraft. We no more have an overdraft. We no more have an overdraft. Can you hear me? Hello, can you hear me? We no more have an overdraft, but then rather we have what we call a bank or cash account, which is positive. It means that the balance brought down will come to the debit side. So we would have balance brought down on the debit side, and that would record 44,900. 44,900. So that is what we send into our statement as our bank account. So just like yesterday, I was telling you, for the assets, we repeat everything here. That is here. But then mind you, that plant had received a new introduction of 30,000, which must be added. And so plant's figure is the only thing that has changed because a footnote item had drawn our attention to the fact that, yes, it is not enough to talk about the replacement cost only, but then there is an additional PPE schedule. The cost plus or the carrying value plus an additional minus disposal minus depreciation will give you the book value of the asset. So that is what it stands to be right here. Okay, so adding all the assets plus the additional plus the cash or bank. This is cash or bank. Mind you, this is cash or bank. So let me write cash or bank. Was the 44,900, and that came as a result of this. So it is no more an overdraft. In our previous statement, we had an overdraft rather. But after preparing the bank account, we realized that there is nothing like an overdraft. It is rather now a positive because there are some payment and receipt of money in the account. Okay, having balanced our account, we come and write our liabilities. What are the liabilities we have? Now, overdraft is no more going to be present because overdraft has changed to become an asset. We've also been told that director's loan, they have waived it. And then we've also been told that this one has been paid off. It was paid off in the bank account. So whatever that is left alone will be trade payables. Trade payables. Even trade payables, out of it, we have paid the SNIT and we have paid the tax. So what will be left to be recorded for trade payables will be the figure here less what have been paid already. And so we have just 58,900 recorded. Any question? Any question? Okay. No question there to answer. So after trade payables, I skipped to debenture. Now, mind you that this debenture is gone off. So we have a new debenture being introduced by the firm. And the new debenture is the, what did I record for debenture? 100,000. So the directors will there. No. So it should be 50,000 rather, sorry. So the debenture, according to the account here, is 50,000. So we record a new 50,000 in our account here. So this should be 50,000. I thought I wrote 50,000. Okay. Now, if that is 50,000, the stated capital should come from you. You are not supposed to reconstruct it. But mind you, that ordinary shareholders already have some 100,000 being received. Ordinary shareholders will have some 100,000 being received. So if I should have recorded 100,000, there will be a balance carried down on the account. So look at it. The difference should be a balancing figure, which you can actually decide to split by adding a little to the ordinary shareholders and then record some for the preference shareholders. So here you are the one suggesting the preference shareholders contribution and then the ordinary shareholders contribution. So to be determined by you using the balancing figure. So 58,900 plus 50,000 from the 420,900. Mind you that there's already 100,000 for ordinary shareholders. So if I take the 100,000 for ordinary shareholders, I only have 212,000. How do I decide to split the 212,000? I can decide to add 50,000 to this one and I record the remaining for this one so that my account can balance peacefully. So this is a balancing figure. But then there's already 100,000 reintroduced by ordinary shareholders. And then we added 50,000, which is a balancing figure. So balancing figure. And so what do you think the difference would be? The difference would be, this is also a balancing figure. You're not going to write balancing figure for understanding purpose. That is why I'm writing it. Okay, so what do you think this would be? 150. 162,000. So 162,000, and then I have my account balance. So plus or minus, we've reconstructed our financial statement, financial position. We have dealt with the first aspect to suggest the scheme. So I'm suggesting that the firm would rather liquidate and then rather not reconstruct. And then also here, preparing my financial position, I have prepared the very first aspect. And the last aspect, which has to do with the stated capital, is a balancing figure. But then there is already an introduction of a new figure. Okay. So that is for Abrokwah Charles question. That is for Abrokwah Charles question. And I know you don't have a question to ask. If you have a question, please do ask.